Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, July 12th, 2022. It is 12:17 Eastern Time as I'm starting the video, and here's what we're going to cover in this order. We're going to do an update on the equity markets. On that, since it's very much related, we're going to talk about earnings. We are later this week, we are going to officially kick off earnings season. I'm going to go over that. It really leads off with the banks each season, so we'll watch those, and that might give us some help to give us some clues where the market's going. And then it usually concludes towards the tail end with the market-leading FAANG stocks, big tech, the Apple, Amazon, Alphabets of the world later this month. So I'll get to that in 1 second here. Then I also, on to me, a related note, more so than usual, I'm going to do an update on commodities. I've shared my theory recently of how things might play out and why they might play out, not just from the charts, but also fundamentally. So I'm going to talk about commodities, quick update there, and then on that related note, we've been, hit and run trading things, kind of veered mostly away from the ag commodities lately, just focus on energy. There's so much volatility on the energy sector. There's a lot of trading ops there lately. And then finally, and that sounds like a long video, but it won't be that long. I'll just do a brief update on the metals, miners, and US dollar and euro. So we're going to go through in that order. And we're going to start out here with the biggest picture. That's my monthly charts. These are monthly time frames, meaning every candlestick is 1 month of trading action. Goes all the way back here to the end of the last previous bull market, which peaked in October of '07 back here. Was about a 55% drop in both the NASDAQ and S&P. That was unusual because the banks fell so hard, and that's why you usually see the tech-heavy NASDAQ will outperform on the downside in a bear market and on the upside in a bull market. The exception there was the financials melting down, and the NASDAQ 100 has very little, if any, exposure to the financial sector. So it's mostly a tech-heavy index, biotechs, other sectors in there, but just excluding or lacking the financials. So okay, so we're not going to spend a lot of time here. I've covered this chart many times in the past. I'm just going to tell you what I told you several weeks ago and before we even got there. We are still, at this point in time, we've pulled back and hit what I call my primary bull market uptrend line. The rest of the world, the media, at least the financial media, will say this is a bear market we're in, and it is by that metric. I'm not going to argue that. It's something I called for, something we're trading. But bigger picture, if you look at a secular trend, there was a bull market that started back here. That was the beginning of all the free money, zero interest rate policy, quantitative easing when the financial crisis hit, and just an extended period of easy money from the Fed. And of course they increased that and went full throttle back and when COVID hit here. But all it did is bring us back to this trend line here, and so that's where we're at. We hit it last month, closed on it. We're trading on it again. Say what you want about the markets, but right now it fell to and it hit a major trend line, and we'll see. One of the things, and I'm going to get to this in just a second. You know me, you can call me Papa Bear because I've been quite bearish, calling for these targets. We're exactly where I figured we'd be. We hit my weekly target T3, that is, a few weeks ago. We're above there, so this is unfolding almost exactly as predicted. So there's no argument there. Where what the trend is when you look at it from the beginning of the year, late November, nor to where I think we're going. I think we have more downside to come. And again, I maintain it's a matter of are we going to rally first. And I still think the case is decent for a pretty sizable rally that we're probably only about a half to a third of the way through yet. We'll see. I'm not married to any one thing, but just want to point that out. So we are, of course, I can make a bearish case as well. We're below this. My favorite trend indicator, the 20-period exponential monthly moving average, does a great job of defining bull and bear trends. So this is a little bit different. We took that out a couple months ago there, and we're well below it. Back here, when COVID hit back in early 2020, we tested both the 20-month and the primary trend line successfully. 2 monthly candles where we closed on or above that, both of those. And also back here in the big Q4 drop of 2018, this spike down there. So, and you can see again we spiked through it, but the 20-month held. So, what makes it a little bit different and makes me very much open to the possibility that maybe the bear market rally is over, is the fact we're still below trend, and you have to put that weighting in there. You're below that trend indicator, the 20-month moving average, exponential moving average, but on trend line support and not far off price support. So said and done, I think we'll break that. We'll work our way lower in the coming years, I believe. I think this is going to be a long one, and I'm going to get to let's just do the S&P 500, and then I'm going to talk about fundamentals. All right, so here's the S&P 500 SPY, same thing, monthly chart, 2009 lows. There's your uptrend line. We had a brief violation on that one when COVID hit, but then you can see this is a green candle, and we closed back above it. So we recovered it, and the same thing, the 20-month has done a great job, but we're below the 20-month exponential moving average, but right on trend. So this, to me, is very important, and we're falling to trend line support. Now, what we haven't seen, and I'm not going to go to it because I need to keep the video somewhat limited. We have not hit my buy signal, the one that usually ends bear markets and corrections, major corrections, and that is spikes to the certain levels that I have my buy zones on put to call ratios, both the CPC and the CPCE, the equity only put to call ratio. Those aren't there yet, nor is the VIX skyrocket. So again, I can't make and I'm not making a case for the bottom here at all. Again, I've never waffled on that. Just a case for a rally before we hit the bottom. So, and you can see we're still on trend right there on the S&P 500. Now let me talk to you about fundamentals real quick, something I covered recently. This is Google Trends. You can Google search the term Google Trends, type in any term you want, and get interest over time. And so, like I said, I can't turn the TV on or pick up a paper or whatever to read the paper on my phone, or really go anywhere and talk to anybody about what's going on without hearing the word recession. And so this is it, a huge spike right here. This goes back to 2004. Of course, there was a bear market in '07, ended in '09 right there. You had a lot of talks about it. We were in one, of course, when COVID hit, of course, and by technical definition there was one there, but it was so brief because the Fed didn't refuse to allow it to happen. I think bad things happen when the central banks try to alter the natural course of the economic cycle. We need recessions, booms and busts. Recessions clear out the dead weight in the economy and allow you to emerge stronger. I've talked on that many times, kind of like how the forestry department does those prescriptive burns where they burn down the undergrowth. So if and when there's a lightning strike, if they didn't do that, the flame would be so big, it would have so much fuel they would burn down the 100-year-old plus, 1,000-year-old, redwoods out there in California and all that. Take everything down with it. So here in Florida or in dry, arid areas, they do that. Those prescribed burns. Burn down the shrubbery from time to time, and so Fed hasn't allowed a recession. They refuse it, and so that's why this one's going to probably be a lot worse. So, anywho, that's it. Point being that my goodness, this seems to be about crescendo and cries for recession. The articles I'm reading aren't just, oh, are we going to have one now? How do you survive it? What it's going to mean to your portfolio, strategies. It's almost it's widely accepted. And again, technically, did we hit it 2 contracting quarters? Yeah, but it's not. Doesn't feel like a recession yet. And again, I think that sentiment has really shifted over, and the pendulum swung a little too far now. And so we'll know. I think this earnings season has the potential to be a catalyst where people realize that, oh, all this talk and rising rates and all that, but hey, guess what? The sky's not falling yet. Companies are still making money. They're still increasing. They're expected to increase dividends to record levels this quarter. So we'll see, guys. Here, let me just show you. Let me jump over to that real quick. Earnings. So let me clear that out. Okay, I posted this under one of the posts this morning that I made. Just check under the comment sections. This is the earnings whispers. And you can also keep in mind, go to the site, the top of the page on the top menu of right side of the chart.com under resources, then go under tools of the trade there on the right and click on economic calendar, and you will get the earnings. You can type in any day, any date, and they'll show you the market movers. They always rank them by the most significant companies that are likely to have the biggest result. But you can see here, really Thursday is when we kick it off. You've got a couple. You've got J.P. Morgan Chase, and that's the big 800-pound gorilla in the financial sector right there. You've also got Morgan Stanley, and then Friday, just a flurry of them. Financials typically report before the open. Tech companies typically after the close. Again, this week is tech. I'm sorry, this week is financials. There it is: Wells Fargo, Citi, Progressive, BlackRock, PNC, U.S. Bancorp, all of them. I mean, it's so we'll have an idea which way the tech sector, or I'm sorry, the financial sector wants to go by early next week. And of course, since they report by open before the open, we'll get a pretty decent idea on Friday as we close the week out. Okay, let's just walk it down real quick. So that's the weekly or monthly charts we're looking at. Weekly I already covered. We hit the third target bounce. We're kind of bouncing between the second target, which is resistance, and the third target. And I still, my preferred scenario still has us coming up here a little more, maybe test one or both of those 200-day moving averages in some of these higher levels here. Not married to it, and we'll see. And you know me, I don't change on a dime. And the other thing is, I don't put all my eggs in one basket. The indexes, stock indexes, futures, whatever I'm trading at any one point in time are only going to be part of the trades that I make. I like to trade commodities. I like to trade bonds at times, currencies, crypto, you name it. And the more things that are uncorrelated you can put in your portfolio. It's the same premise of investing. Don't put all your eggs in one basket. Use asset allocation, diversification, and help smooth out the bumps and enhance returns. All right, so this is the primary trend line I've talked about. We tested this yesterday, or came close on QQQ. Remember, the posts I got out to you yesterday morning were close, but not all the way there. In pre-market, we did hit this today. Here, let me jump down to a 60-minute chart. Go to this one I've been using. See the white candles? They're the pre-market trades. I've turned those on, so that's where we were this morning. Actually, no, we did have a back test yesterday. There's a back test again today. This was your breakout. Again, that's the primary trend line, the one that I'm looking at that comes off the early April highs. And so I did see some comments on the homepage, and I welcome those. Something like, oh, still holding on to that bullish call. My God, if one day down, I just told you the other day, I told you we had a record 5 days of green candles. We hadn't seen that through the entire bear market since the S&P and Nasdaq 100 peaked. Again, I said don't read too much into it. We've had bigger moves in 5 days or about that, but 1, 2, 3, 4, 5. So you're going to get a red day in there. And if one red day, especially if nothing changes, see the way I am, it's not that I'm married to any one view. If the technicals change, we came in and we smashed through the trend line, the breakout failed. That was a failed breakout, and then we took out support below. Absolutely. Then I start to, second guess my views. But, certainly when you're very overbought because 5 straight days on the short-term time frame, it's not on the day. Even you were overbought on the daily there a little bit. But, no, I'm sorry. We're up about the 50 level on the very short-term time frames. But that doesn't change anything. In fact, it just it gives a buying opportunity. And so, my mindset is, if you're bullish, if you are, and you don't buy a pullback like yesterday, or if we get another pullback, then you're trading you're trading contrary to how you should be. In other words, when you're in an uptrend, you're going to get better prices if you buy the dips, buy pullback to support. You can also buy breakouts above resistance. Those are your two objective times to buy, but you don't buy a rally into resistance. You ideally don't want to buy overbought. You buy those corrections that occur. So that's it. So hey, right or wrong, this is my analysis. As of now, we're still looking fine on the Nasdaq 100. Again, going back down to that 60-minute chart, coming in here and back testing. And targets are still, I'm looking for a move up here. That's something I've been eyeing since we hit the lows there, and I pivoted from short, closed shorts, went long, started going long there, and that's about 305. and let's see if and when we get there what it looks like. I may extend additional targets. That's just a near-term target. Remember, we've already, oh, and we need to take out this level. We had almost, it was about flatline divergent, equal highs. That was on the chart there, slightly higher high there, and that was the catalyst for this little pullback here. But now that's a level, and I'm going to add it to this chart here because that's significant. Those are two previous reaction highs, about 296.83 or so. Obviously, that's the level more important now than 294.60. So I'm going to tune this one down a little bit in color just to show it's not as significant as 296.83 because that's where our previous two reaction highs are. So we need to pop that. So back to what I was just saying, you can buy pullbacks to support or breakouts above resistance. These are your objective entries. Pullbacks to the support level, nice price support if we drift a little lower at 285 and change to 285 even. I'm sorry, and the trend line. So I'm fine buying pullbacks to this level, but really don't want to see us go much below that 285 as I mentioned this morning in one of my posts. So all right, let's do this. Let's look at the FAAMGs because that's what makes up the market. And again, the Qs to me are the market. It may not be as diversified as the S&P 500, but it's my preferred trading proxy. So we're going to look at those real quick on a just 60-minute basis, 60-minute chart. Here's Apple. Apple primary downtrend line, just like that trend line on QQQ. Breakout, back test, and it just took out a previous high. That, perfect. From a technical analysis perspective, this is what you want to see. You broke out. You were getting a little bit over a stretch there, a little bit overbought near term. You had a back test. The buyers stepped in where they should have. So the biggest, most important company, the NASDAQ 100 and S&P 500, looking good so far. Starts to not look good if it fails the breakout, moves back solidly back below the trend line, and of course if it starts taking out some of these big support levels below. As of now, looking for a move up here to at least that 150, 150-ish level right there. Possibly more. Microsoft, similar thing here. You had a primary trend line there. You had a whipsaw, which I already addressed because when it had that breakout, at the same time QQQ and Apple both ran into and stopped at their downtrend lines, got rejected. And that's why that was a breakout that should not have been taken. And those that did take it had proved to be a false breakout. But then when QQQ and Apple did break out, Microsoft also did break out. So it's doing the same thing. Breakout, back test, close to a back test, and should hold above, ideally above 251. Alphabet, what I see when I look at this one is this whole area down here, just this basing pattern right here. It's been bouncing around, playing ping pong with a big level here. It needs to take it out with conviction, and that's about 2371. And if so, that's a powerful, again, that's a potentially powerful basing pattern. It could also be powerful the other way. If it takes out the bottom of it, about 2110, that's going to be quite bearish. If it breaks the upside, I think that's going to be quite bullish and could lead to a rally that's a lot bigger than most people can even envision right now, because again, the masses believe we're in a bear market with a lot more downside to come, and I just think there's considerable upside to come before the next leg down, and then a lot more from. So I can't, believe me, I take it day by day. I can't wait to trade it long, see how, if that pans out. That should be a very profitable run to trade. A lot of shorts should start to get squeezed, and then to recycle in when time is right for the next leg down. I don't know. So far, it's been a great year for trading, and the thing is stay flexible, not get married to that view. If I change my mind, I'll let you know. But as of now, there's really nothing in the charts that have changed. If anything, everything's being reinforced. There's Amazon, breakout, backtest, same story. I can go through these again and again, over and over. There's your divergence, positive divergence, that is right there. We already had this trade here. We went long. It was highlighted as objective long here, and then exited here, then re-entered here and here again, and now it just needs to break out this kind of quirky inverted W pattern, whatever you want to call it, right there. Looks like a head and shoulders, but those are head and shoulders are topping patterns, not bottoming patterns. Either way, there's a lot of energy building in here. Buyers and sellers duking it out. So if the buyers can ramp it up here, we go up, hit my third target at 135.63. And if we break to the downside, it ain't going to be pretty. But we're comfortably above the bottom of the range. And like I said, we're back testing. So there's your objective long entry on Amazon if you want it. Tesla, I don't know. With everything Musk has going on, might be noise, dead weight. But it's also people, it's a beloved market leader. Same thing, building energy here on that range. If it can pop above it, great. And there's also a downtrend line to take out. It can run, should run. All right, and I could go through the rest, and I have. I've laid out semis as a long trading op right now. A lot of semis are setting up for a big move. I just showed you big tech is setting up for a big move. And remember the big tech names. Most of the FAAMGs report at the end of the month. And still on the equity markets, before I leave it, I told you I'd hit on the financials real quick. We just hit and remain at T3. That was this reaction high right here. Third target on a short for really that started way back here, hit the first target, and we went sideways. We never violated a reasonable stop on this marginal new divergent high, and I maintained these targets, and we hit them, and that was it. I only listed these three. I do think over time we do go lower, and I think we'll know by the end of this week, early next week. But when you look at it from this was my weekly target. This is good support. This is why I am a bull right now on the markets. Look at these levels. That was a major high right before COVID hit, and we tested it there for a while, broke out, and this is the first back test of it. So there was a divergent high, and rightfully so, this big drop in the financials, which it was called for, but here, we hit targets. And the, economy, everything's topsy-turvy right now with all the Fed manipulation, but overall, what I gather, I was scanning the headlines today. Was it London's Heathrow Airport? I think it was. They just said they have to not outright shut it down, but they are having to restrict entry and curtail the flights because they have a shortage of help and they're so busy. They're flying so many darn planes. I heard somebody was in the Caribbean recently vacationing, said everywhere they went was crowded. So, the media is making it a henny penny situation. And again, this is when everyone was bullish and in denial that we were going to see a recession this year. I tuned in more than I ever do, turned on the TV. I usually don't listen very often to financial media, but I just want to hear, and all the talking heads here were bullish and saying no chance for recession this year, maybe in 2023, and now they're all crowing for a recession and how bad it's going to be and how much more we have to go. And that's when I want to take the other side of the trade. So, all right, I don't want to beat a dead horse. If things change, I'll let you know. And then the individual banks, I can go through them. JP Morgan, big old gap. This is a weekly chart. There's a big old gap right here. And we're testing the top of the gap. Here's what I can see, guys. I can see a little more downside. If that gap gets backfilled, and this is much better support. It was a target I had for a long time, 103.70, and we're not there yet. So I think, again, just my thoughts, at worst case scenario, I see a little disappointment earnings, a little weakness over next week or so. And then nice support there. And sometimes the financials can do their own thing, and as long as tech holds up, because I told you that's what I've been watching, and that's one of my cues. One of the things keeping bullish is the charts on the market leaders. Remember, JP Morgan, biggest bank, biggest financial institution in the country, in the S&P, and probably, I believe, the world, but it doesn't move the needle nearly as much as Apple. And so that's what I'm watching here. So this could happen. I have no position in the financials. I'm just showing you that's what's going to happen this week, and there's going to be a lot of buzz and talk about it, because if the financials are in bad shape and the economy's in bad shape, blah, 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 and vice versa. So you can see my charts. I have them all, a lot of gaps there. Better support down if we could get one more thrust down, and you could see a lot of them coming up to trendline support. Schwab broke there. So there's my thoughts, guys. It's not, I don't want to touch it, but here it is on the daily chart. Lots of divergences. I just flipped over to a daily chart. We were on the weekly chart. And so we could rally here. We don't have to go down and hit those next targets. If we do, great. I will be a buyer, JB Morgan down here at 105. Well, if I decide to buy that, I could also go with XLF or any other financials. But if I see a lot of them come down there, that's the really good support level. That would be a really nice entry. So that would mesh with earnings gap and crap. They crap out after earnings, hit support, keep these divergences in place, and there would be nice buy points for a very nice rally, I think, so on the financials. And they may never get there. They could turn around, but they're so close. I'll just tell you from experience, usually when you get that close to big support levels, it's like a magnet or a black hole that just wants to suck it in and get you down there. So that's it. And look, there's Bank of America. It's only 5% down below what was JP Morgan. So this should help quantify what XLF might have to the downside. JP Morgan to that 105.11ish support was 6%, so about 5-6% downside. Heck, you could start scaling in here with stops somewhat below there, because the upside, whether they go from here or not, I think they could run back up here. Again, run at the 200 days like the market, and that would be roughly 20+% upside. All right, I'm going to get off those. They all look the same, guys. I can go down each and every one on the daily chart. Positive divergence. Remember, positive divergence is not a buy signal. It's a condition. Buy signals are breakouts above support, or objective long entries, or pullbacks to support. So these divergences, if we get one more marginal thrust down, will still be intact. I just moved these lines a little lower, but we're making higher lows on the indicators with lower lows on prices. So any quick thrust down followed by a reversal will keep those divergences intact. And then at that point, I might be a buyer, or might even throw out a trade idea on the financials for you. Alrighty, let's move on. Okay, so the little theory I floated out recently was that although, and again, it doesn't surprise me at all, the Fed is the most reactive, behind the curve entity I've ever, especially for holding such a powerful position, not just Powell, the entire Fed. Anyway, they're still on their full-blown hawkish mode. We're going to raise 0.5%, 3/4. Seems like what the speakers that have talked about over the last week or so have said. But here's DJP, commodity ETN, move down off the divergent high. Again, it was very priced in, big old divergent high. This is, to me, one of the most balanced and broad based. It's not too heavy. Some of the commodity tracking ETNs are too heavy in energy, so it kind of skews it. This one has a good weighting of energy, but has a lot. You can see here a little of everything. I don't know if you can see it in the video. You can look it up, TJP. And so look, we had the divergent high, and we've had a heck of a correction, and this tells me there's been a tremendous abatement in inflation. Remember, this is my real-time inflation tracker. I don't have to wait for quarterly or monthly CPI numbers, which are lagged and dated and subject to revision. This, of course, you need to couple with what's going on in the housing market, because shelter is one of the biggest components of inflation. But you can see we've had a very nice abatement here overall in general commodities. A lot of that, especially in the energy. And yeah, energy has a big impact on this drop, but that's just about everything has fallen. Ag commodities, everything else. And remember, energy has a bigger weighting in there. But then the ag commodities are important as well, because that's food. And so you have about a 22% drop. It played out as it should have off the divergent high. You had a little trend line break there. Bear flag. We were short crude oil and nat gas way down. Trade them in and out. Traded them long today and got out. And then so here's what I want to say happened. So although I highlighted that the other last week, I also told you I was started going long in a lot of these, looking for a bounce, and that's where the bounce I think is going to go to. Look at that. That was the 34.63. It's good support. Right there, there's a big old gap. So if this plays out the way I think it does, boom, little rally there, rejection today. That's what helped me get short crude and natural gas. And I think we come down here, and then this is where I'm going to be. The next time I'm going to be a buyer for swing and trend position, IRAs account for commodities. And when we get down here to that 31 level, I think that's a good support level. And that's probably where we're going to go. So if this plays out this way, and it's what I favor, then you're going to hear more and more talk about how inflationary pressures are easing. The price of gasoline is off highs. Natural gas is way off high. We're talking, 40, 50% drops in these already. And, wheat, corn, soybeans, and all that. So if that plays out, I think that's going to be the narrative here in the market, and you'll start to see the Fed make hint of it or outright state it at the next meeting that they've seen abatement, inflationary pressure, blah blah blah, and that allows them to, back off a bit on rate hikes. And then here's natural gas. Keep in mind, the chart I used when I was trading in the September's. It's a little more volume, but people are starting to roll from the August to the September contracts, and that's what I gave you today. Or you could have used UNG or what's that? Boil or cold, KOLD. But that's a big level right there. Lot of major reactions. That's why I had that line dark. So this is a case of, this is the swing trading time frame, my 60-minute chart, my favorite go-to. A little divergent low right there. You got a rally that set up this, with this bigger bullish falling wedge, but then you had this small bearish rising wedge, and it took us right back to a great resistance level. Again, that 6,578. Rejected there, broke down. Here's the takeaway. All right, I already covered this trade. I got it out with static charts today, both in pre-market before the, at the time of the entry, and then we hit there. Told you, drew a little arrow, probably get a bounce. You could trade that as an active trader, maybe go down. I gave the bounce, reversed it down, and then out. So I had really 3 trades today: short, bounce, cover long, cover the short, go long, bounce, and out. And I'm done for now. But here's where I'm going. I think we'll see more downside, most likely in crude and natural gas, and that will give us that further abatement in commodity prices or inflationary pressures. I should say abatement in inflationary pressures with crude and natural gas going down. It's going to be choppy. I'll wait for the next good setup. But I wanted to show you crude as well because that's almost an identical chart here. Remember, this is the last, I don't know, there's trades all over the place here, but, swing it down here. That was one entry there on the break of that trend line. T1 hit T2, T3, T4 was the final target on that trade with this uptrend line, which goes to the left of the chart. There's a lot of reactions here on this uptrend line, and so that was also almost identical to the NG trade. You had fell to support right here. We had a divergent low, positive divergence, rallied back up right into backtest the trend line, and then while backtesting put in a divergent high and then got rejected off the trend line, and we're coming back up to support. But the bigger picture is we took out this primary uptrend line, and so the bigger picture is a breakdown backtest. Here, I can probably show it to you on a 6-month chart. Let me see. Yeah, there it is. All right, so this is what it looks like, bigger picture for crude oil. Primary uptrend line, and it still goes to the left of that chart, and we're going back 6 months. Breakdown, backtest, rejection. So as of now, this is keeping crude in an intermediate term downtrend, and this somewhat at this point in time, it's for crude traders, it's almost a double-edged sword. Yeah, I know what's going on with Russia and Ukraine, all that. That's, we got to factor. Just trust that the charts have a lot of that priced in. There's still going to be volatility with what goes on over there. But if the stock market does take another leg down and go lower, it's going to put a headwind on crude, because then there's going to be that increased talks about a recession or a recession that's getting worse, and then demand destruction. Demand destruction is a real thing for crude. So yeah, you can take the Russian oil offline, but if all of a sudden you have a lot fewer planes flying in the air, a lot less people driving around in their big RVs and going on vacation and this and that and boating, you see an abatement in or a lack of demand, or collapsing or decreasing demand, I should say. And how far it decreases will depend on really what the economy does. So anyway, that's it. So I've spent enough time showing you the charts and have shown this drop. I do think there's one more leg down in commodity prices. Crude, I don't know, maybe right here. We'll see. We'll follow the charts, see where it goes. But maybe another, just eyeballing this, and that might mesh with DGP, the commodity ETF I just showed you, about another 9 or so percent drop in crude prices. Then might be time to go long. Could be less, because we'll have, if we get a little, we undercut the recent lows, we're going to have a divergence here on the hourly chart. Anyway, I just want to show you that's what's going on, and those are my thoughts. Let's watch earnings on the financials, see what they say, and finally I told you I would cover natural gas. I'm sorry, the metals. Covered natural gas. Let's see. Start with gold. We're on a 3-month chart. Here we have gold just can't get started, and that has to do with the euro. So today I've been covering the euro and kept thinking we would bounce off that long-term support, and we never did. But that doesn't faze me. So today, for the first time, I got a trade idea out to you that's more of an official trade idea homepage, because I'm really, if I like the euro recently at support, I gotta love it now, even though it broke that long-term support. But then what the headlines are talking about, the euro becoming in parity with the dollar. And this is the long term. Here's what I'm talking about if you're just catching up. This was long-term support, major long-term support zone. We broke it. Now, here's my thing. When you break support, that is bearish. But you're not, from my experience again, especially in something as important, there is a mean reversion process that comes into place with currencies, especially the major currencies. I'll chart the euro US dollar because the euro is the biggest component by far of the dollar index. So the thing is, when you break support and you're already oversold, how much more are you going to go down? Are you going to waterfall down? Look, the financial system will break if the euro just craters. You're going to see all kinds of problems over there, and the central bankers aren't going to let that happen. So I think at this point we're probably looking at a snapback, at least maybe a back test. The trade idea I gave you is just short term anyways. It's based on the 60-minute charts here. I had on this one. This is the one I gave you today. You can see that we have nice positive divergence. We come back up here, and this is the projected path of this trade. T1 resistance zone. I called it T1, meaning first target / resistance. I'm treating it more of resistance. I think we'll get a little reaction there and or this trend line, but this is my preferred swing target. And it's not much, but where I got it out to you this morning, I think we were right here. We're talking about 3.25%. And I mentioned that if you trade futures, they're already leveraged. I don't need to tell you how to manage your size there. If you're sophisticated enough to trade futures, you know exactly what the leverage factor or multiplier is on each futures contract. So for those that want to trade something like an ETN, in this case FXE, I said my suggested beta adjusted position size would be anywhere from 4 to 10 times. What does that mean? 4 to 10 times what you'd trade on SPY or something that's correlated with the broad market, because you're not talking a big target. We did what we make on if you took cold today and took it where I said you made 21% in 2 hours. Okay, that's a commodity. That one you beta adjust down because it's so volatile. Because if it went the other way, you would have quickly lost, on that 7% or so, 5, 6, 7, if you were stopped out. On this, you're only shooting for 3, and you might say, why am I going to mess with 3%? I'll just stick to natural gas. Well, because this thing isn't going to fall 20% in a day or 10% in a day, and because it has much lower volatility, and it's a currency. So therefore, you can use a much larger position size. Everything's relative. So if you use 10, let's just say the extreme, 10 times the position size, you're making that equates to a 30% gain on a normal position, something like the S&P 500, because you're juicing up 10 times. Now you don't have to do 10 times. You don't have to do 4. If you don't know what you're doing, paper trade or use one time, no leverage. But if you're shooting for a 3.25% profit, you want to give yourself at least a 1% downside. And so that's the same thing. Your loss is only going to be 1.5% to the downside if it doesn't pan out. And so if you took an overweighted position, that's not going to kill you either. And so that's why it cuts both ways. So using a bigger position makes a 3% gain, if hit, worth it. Of course, there's the potential a major bottom could be in if this proves to be a whipsaw here in the euro. If that long-term support zone is recovered, that could send the euro a whole lot higher. And if that's the case and you think that's a possibility, you get a good entry here. Just let it run and periodically raise your stops if and as the trade starts to pan out. That's trend trading. Right now, I'm just looking at it as a quick swing trade. Get out, get in, get out, hit and run. If it pans out, great. If it doesn't pan out, great. Move on to the next one. There's a lot of other fish to fry. And then finally, speaking of those other fish, on a related note, and obviously, it's gold is correlated to the dollar, inversely correlated to the dollar, which means positively correlated to the euro. So to be long and bullish gold right now is to be long and bullish the euro. They're about the same. They're moving in almost in tandem here perfectly. And of course, you have same thing. You had divergence recently. I'm just moving my lines. Still have divergence on the 60-minute chart of gold. Needs to pop that level 1745, and then it can make a run up to. Let me drag this line down here and just use that one. I'd say there about 1800 would be a near-term target for gold right there, and maybe that trend line, that downtrend line as well. Silver I like a little better right now. I already had some coming into today, and I just took a little more. Nothing big, just a little starter position on the metals. I did go pretty heavy on the euro, and I'll add to the metals if these break out. Let me show you silver real quick, and then we can wrap it up. SI, bear with me. I've got a lot of charts down here. Here it is. SI, nice little bullish falling wedge here on the 60-minute chart. You got the downtrend line right there. You've got your divergence building, and you just need that spark, which is a break above the trend line, and then my BOD, or benefit of the doubt line, is 19,328. So that would be sell signal 1, buy signal 1, buy signal 2, and then boom. And I have a pretty clear shot up there that's a near-term swing target. That would be, if hit, that's about 8%. So there's another example that silver, you don't take as big a position. You could trade the euro to get there. They'll probably get there together, or you could trade silver. Silver is, much more volatile. If you're right, it's going to go up more in percentage terms, and if you're wrong, it goes down more in percentage terms. So you're talking about an 8.25% gain if hit to that first target there, and if that one can go, then next stop up there, swing-wise, there's certainly a resistance level in the middle there that I would point out. About 2150. But so even that, a quick 8%, hit it, get in. As an active trader, I like to do that. Do my thing, go up here, reverse, and then maybe recycle back in on a pullback, maybe to that reaction high, something like that. We'll see. And of course, if those breakouts play out in the near-term bullish scenario, that should help GDX. Still at support this level here back from that support back in late 2019. It's the 2615 level. Big bullish falling wedge. PPO is still curling up, guys. See, what happens is if you get frustrated, we haven't taken off, we haven't gone anywhere, but we're not going lower. We're back, really just grinding around this range for the last week or so. And so what happens here, you can see if you zoom in real tight, the PPO is starting to curl up. It has not turned up, and it certainly hasn't crossed over yet, but that's what I'm going to be watching for, because the momentum was down. It's a momentum indicator, so when you're going down, it's pointing down. But then when you start to slow that rate of descent down and even start to turn around and consolidate or hold support, these indicators will start to turn up, and then you can get that bullish crossover. And don't underestimate how fast the miners can go up if the metals rally. I think it would be a quick move up to that 2893 target. That's about, if hit, again, watch the euro, watch the dollar, watch the metals, 10.5%. T1 is still up there about 18.25% from where we're at. T2 zone, the bottom is about 26%, and then ultimately T3 about 37%. And as I said before, this will most likely is most likely contingent, especially these upper targets here, on my stock market rally scenario panning out, because these are equities, they are stocks. So all the better if the stock market can rally. So I just wanted to reiterate, I am still long and bullish the miners, waiting for some additional evidence, such as a breakout in silver, such as a break of this trend line here, and I'll layer in and add to those positions. All right, guys, that's about everything I wanted to cover. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.